And from Bloomberg World headquarters in New York, I'm Joe Weisenthal.
I'm Romaine Bostick. Caroline Hyde, she's off today. Let's take a look at where markets ended the day here, because the dip buyers came back into treasuries and they came back into stocks.
The question is, what'd you miss?
All right, put in on the brakes. The Fed lets a capital break for big banks expire, and the tech stock decline takes a break as well, at least for one day here. Bank shares lower in the session as the U.S. Central Bank denies requests from Wall Street to extend the relief from that SLR. That's the supplementary leverage ratio, if you're into that kind of thing. Meanwhile, Facebook helping the NASDAQ 100 snap back from Thursday's sell-off. And Joe, it's a whipsaw kind of week here. And we had quadruple witching, which I'm told is technically triple witching, but we're going to call it quadruple witching for reasons that I'm not quite clear.
Yeah, and I don't know why it's witching, because it's never that weird or anything. And you look today, it's probably literally the quietest day all week, if not the last 2 weeks. Nonetheless, a pretty dramatic week overall with some volatility, especially the last couple of days in the wake of the Fed. And we do seem to see this phenomenon still, by and large, of tech, which had been leading, really moving inversely to treasuries over the last several days. We saw it more this week, and I think for a while this will be the key dynamic that people watch.
That's quite the chart there. Mean reversion.
Yeah, there you go. Yeah, I think so. For more, let's bring in Bloomberg's Katie Greifeld. Is this going to be the dominant thing that we're just going to keep watching for a while? How long the 10-year is sort of like in control here?
I think so. I mean, is there anything else to watch?
No,
It seems to be controlling everything right now. I mean, that was a great chart on how tech in particular is moving inversely to the 10-year Treasury yields. As we know, that has huge implications for almost every benchmark worth watching. And so that's going to be the dynamic I think that markets are going to be glued to. Kathy Jones on Twitter from Schwab actually had a great quip yesterday that everyone's a rate strategist now, because it's really the bond market driving things.
Yeah, a lot going on Twitter these days. I am curious about the trend line here and what you're hearing from folks with regards to the trend line on yields here, because it seems like to me this is still going to go higher. But you have a lot of people saying, don't worry, once you get to around the 2% or so, it'll all kind of peter itself out. I'm not quite sure I understand what's going to stop this.
It's a good question. I mean, technicals could come into play at a point. And you actually had a really dramatic headline on the Bloomberg terminal this afternoon that the bull market in bonds is now over. That hasn't happened since 1981.
Whoa.
I mean, yields have been going up for a while, but specifically what happened here is that you had the Bloomberg...
How long was that bull market? It was like a 3-decade bull market?
Just never ending.
It had to end at some
I think
point,
that's
right?
just normal at some point. But the Bloomberg Barclays U.S. Long Treasury Total Return Index is now down over 20% from its peak. So those are the types of stats, the sort of trend lines that are broken that could start to, entice dip buyers. And actually, we got the latest data from the CFTC positioning desk at 3:30. And it shows that speculators are actually now net long on 10-year futures. So we haven't really seen dip buyers emerge too strongly in the bond market, but that could change next week, especially with the SLR news in the rearview mirror.
Don't we also Powell speaking 3 times next week, isn't he?
No,
we thought it's okay, Fed decision done, we'll take a break, but it just keeps coming.
He's the busiest man in Washington, I think.
Well, he has a Fed chair.
He does.
Well, he's going to be on Capitol Hill, right? I know with Yellen, right? Apparently they're doing a joint appearance, I guess, to explain all the pandemic policies.
Apparently, so that's going to be something to watch.
Yeah.
I mean, I don't think anyone's expecting him to diverge from the message that he's been trotting out over the past couple of months.
Yeah.
But we will have the opportunity to hear from him that, he seemed to thread a good needle on Wednesday. Risk assets were happy on that day. Things obviously changed yesterday. But we could see some more back and forth action just as he speaks.
One more thing. What else are you watching?
What else am I watching? I mean, I'm curious to see what happens with this SLR thing.
Yeah.
Treasury market, Treasury yields. I mean, you did see the 5 to 10 year take a little bit of a hit. You saw bank stocks arguably take a bigger hit. They were the worst performing sector today. So maybe that speaks to this being more of an issue for the banks than for the Treasury market.
Yeah.
But it's going to be interesting to see how they grapple with that.
I was surprised at how many banks got dragged down by it, because I always thought the SLR was kind of confined to the big systemically important banks, and then you had all these regional banks getting dragged down by this today.
Absolutely.
All right. Katie Greifeld there, Bloomberg cross-asset reporter, helping us break it down here on this Friday. Have a wonderful weekend. Coming up here on the show, the Fed, of course, to end that COVID-19 capital break. We were just talking about it. We're going to talk to Joshua Younger, J.P. Morgan Managing Director. That's coming up next. This is Bloomberg. All right, welcome back to What You Missed today. We are focusing on some of the breaks we've seen on the market on this Friday, Joe. Of course, everyone talking about that Fed decision regarding SLRs. I learned more about that today than I did in my
Than
entire
you
life.
ever did in your entire life. That's right. The Fed coming out, removing the suspense. That exemption from the liquidity supplementary leverage ratio will expire at the end of the month. It allowed the Fed to build up these reserves without offsetting them with capital. There might be some change nonetheless at some point. The Fed says it's considering permanent changes, but for now, that is set to expire at the end.
Yeah, and we've heard from a lot of bank executives even leading up to this, the idea that there really just needs to be a reassessment of some of these capital requirements.
Pretty complicated topic. So we're very excited. We have Josh Younger, J.P. Morgan Managing Director of U.S. Rate Strategy, and a literal astrophysicist who can actually understand this. So, Josh, thank you very much for joining us. How surprised were you by today's announcement that they're just, for now, just going to let it expire at the end of the month?
It was a little surprising in the sense this is the if it ain't broke, don't fix it kind of thing, meaning, the market was taking it pretty well and it was pretty effective, this rule change in avoiding some of the more problematic outcomes last spring. So, in this environment with reserves growing very rapidly and deposits on the back of them and banks just have a leverage problem because of Fed policy, not necessarily due to their own management decisions, it made sense to keep at least some form of exemption, especially for reserves, which are completely riskless. They're basically just cash in the vault, to maintain the orderly flow of markets. So it's a little surprising to let it lapse, especially if you're also offering to reconsider the rules on a longer term basis, which is kind of an acknowledgement that they need some changing potentially. But I think the longer that the Fed waited, the more the market came around to the idea that this was not necessarily going to be a completely banal outcome, that not like a Canadian outcome where you just extended another year. I mean, they were looking at meaningful changes to the way the banks manage themselves.
I am curious, Josh, as to whether you think or anticipate that this would have any sort of meaningful impact on Treasury buying.
So I think there's two things going on. The first is, banks really aren't in the business of speculating on rule changes in the future. They don't make decisions that are for long-term investment purposes and then have to be unwound quickly when the rules change. So for the most part, banks have been operating under the sort of essential assumption that these rules were temporary, because that's what they were told. This is a temporary relief package, and that facilitated some short-term activity like repo lending and trading activity. But in terms of the portfolio, the investment portfolio, no decisions there were really made on the basis of some expected outcome on these getting rolled forward. So you certainly shouldn't see selling of Treasury bonds on the back of it. The question is really what is in the bank's economic best interest, because at the end of the day, leverage constraints will restrict their ability to act economically, but banks are in the business of acting in their own economic best interest. So it's an interest rate risk management decision and it's a relative value decision. And so allowing these rules to sunset doesn't immediately constrain banks. Banks still have a decent buffer relative to their SLR requirements, even without these carve-outs. But the question is down the line, towards the end of the year, will their activity be somewhat more constrained and their ability to purchase securities, or at least, not engage in the kind of leverage arbitrage transaction, taking as much risk as possible with the incremental dollar balance sheet. That's where that kind of decision-making comes up.
So as mentioned, and as the Fed made clear, we haven't really seen the end of the story, it seems like, and they're going to consider further changes to the SLR, perhaps acknowledging some of the issues that you mentioned might arise. What might a permanent fix? So if it's not a permanent exemption, but something to address this issue, because the Fed is obviously creating reserves nonstop. They have to live somewhere, and in theory, the current rules penalize the banks for holding what the Fed forces them to hold. What does a potentially permanent fix look like?
So I think there's a lot of consensus that reserves, and specifically reserves, not reserves and treasuries, are really in scope for some form of exemption, simply because they're, again, cash in the vault. So there's no credit risk, there's no interest rate risk, there's importantly no liquidity risk. I think with treasuries, we found out last spring that there was significant liquidity risk under the right circumstances. So there is a sense that there's at least a decent argument in favor of permanent exclusion of reserves at both the holding company and the bank level. And that distinction, I think, is important because those reserves sit specifically in the depository institution, the bank. They're bank reserves. They sit with the bank, and those are two different sets of rules. The Treasury exemption I think it was much more about risk management in the context of a very active trading environment. So it was less about what the bank was going to do in their investment portfolio and more about what the dealer had to do to facilitate liquidity in the treasury markets, because it's a very balance sheet intensive business. The size of the balance sheet needed to facilitate that activity, to intermediate transactions, can swing around quite a bit. And last March, there simply wasn't enough of it to go around. So the SLR exemption was first enacted at the holding company level, in part because that's just the Fed, so there's less need to find consensus, and also because that's what affects the dealer, that's what affects market making, that's what was needed to specifically treat the malfunction in treasury markets at the time.
So a lot of people now, at least investors, Josh, are now looking at this move today and starting to wonder about QE and how that gets rolled back, if it gets rolled back sooner than expected, and how the Fed is preparing for it.
Yeah, I think what we found out is it's kind of a funny situation where we're worried that there are too many reserves. So a lot of people have pointed to the increase in counterparty limit for the reverse repo facility as related to this. Those are two completely different decisions for what the Fed has told us, and one's the monetary committee, one's the board. But I think the way to think about this is that the Fed is buying treasury bonds. They're creating new reserves with which to buy those treasury bonds. So a big part of QE in principle is to provide liquidity to the market, to take securities out and put cash in. And then we're also in a situation where leverage constraints mean there's simply too much cash in the banking system. So banks are incentivized to push that cash out of the banking system, presumably into money market funds, which then don't find enough short-term investments. We've heard this story before. And so they go to the Fed and to the reverse repo facility. So now the Fed has created reserves with which to buy treasury bonds and round trip them back to the Fed through the money market fund complex. So it sort of begs the question, is there too much liquidity in the market? Is there more than the market actually demands for its own purposes? And at that point, what is the efficacy of QE on a longer term basis in the context of these balance sheet constraints?
So why not? I mean, why not just make treasuries also deemed risk-free? I mean, there's no credit risk. In theory, you can repo them and get liquidity for them at any time. Why not just make it, especially again, since the government is certainly issuing a lot of treasuries these days, just like the Fed is issuing a lot of reserves, why penalize banks for holding them at all?
So I think what we learned in 2008, in particular, is that just big is bad in lots of respects, meaning systemic risk is in large part proxied simply by the size of an institution. And in a lot of cases, the significant losses faced on credit derivatives and interest rate swaps and things like that were between institutions with very good credit ratings and even very highly collateralized, very risk-free type swap investments. The question is, if you're very large, even if that is a treasury portfolio, you can take losses. There's a huge liquidity risk potentially in the kind of shock we saw last year. There's a little endogeneity to this, meaning the reason why there was a liquidity shock last year was in part because of balance sheet constraints. So by including treasuries in the leverage ratio, we're kind of ensuring that in the event of a large enough shock, we do have another liquidity problem. It really affects the way banks think about managing their internal allocations of balance sheet. But I'm sympathetic to the idea that reserves are one thing because they're completely fungible. They can be transferred without transaction costs. Like, it really is like a paper money situation. Whereas treasuries, though they bear no credit risk, do have all kinds of other sorts of risk, specifically liquidity, and eventually interest rate risk. There's potential for banks to be sort of on the wrong side of interest rate moves. So this has been put forward by a bunch of different people. I think it makes sense. The question is, what are we trying to facilitate here? And you raised the issue of the Treasury funding the deficit. And there's definitely some resistance to the idea that we should be making regulatory decisions to facilitate deficit financing. That sort of hints in the direction of fiscal dominance, and we certainly don't want that. Even though this isn't monetary policy, it's sort of related. But on the other hand, like, if you keep creating reserves, at some point you're going to have a problem, and you either are forcing banks to raise capital at potentially disadvantageous levels and be massively overcapitalized relative to the risk they pose to the system, especially if those are mostly reserves, or you have to think about longer term fixes. So these counter-cyclical buffers that have been proposed are one way to go, which is in good times you hold more capital so you can draw it down in bad times. And so if banks had come into 2020 with a sizable buffer, and in particular business management practices that prioritized it, they would have been better off.
All right, great stuff. The best explainer of this stuff there is Josh Younger, JP Morgan, Managing Director of U.S. Rate Strategy. Thank you so much. And you can hear Josh next week on Odd Lots, myself and Tracy Alloway.
All right, Joe, all the talk this week was about rates, but we didn't talk about crypto. Morgan Stanley, there was a big news story a little bit earlier this week about Morgan Stanley going to allow, at least its rich clients, I don't know what constitutes rich, to enable ownership of Bitcoin. What about the poor clients?
Finally, the rich clients can get access to Bitcoin. And of course, that's been the story of a while. People talk about adding it to your portfolios. People talk about the diversification approaches. Even say like this is the new 60-40, 59-5, 39-5, and 1.
Who says that?
I don't know. Actually, I hadn't even seen that before until this chart. I literally made that up when I saw the chart. Apparently, it's a thing. But I want to bring in CoinShares Chief Strategy Officer Meltem Demirors. Meltem, is this the new thing, 59-5, 39-5, and 1? Just add 1% to your portfolio of Bitcoin and suddenly everything takes care of itself?
So look, JP Morgan says 1. We did some research this summer where we found in traditional 60-40 portfolio, you're better off with 4. So I'm going to go ahead and be aggressive and say 4, which is 4 times 1, believe it or not.
This is, this is an interesting move here. I mean, we've already seen, in all seriousness, we've seen this sort of move already with folks adding this to their portfolio as a legit asset, as a legit sort of percentage of how they sort of calculate this out. I guess when you sort of, if you have a big portfolio and you're trying to also balance out risk here, do you think there's adjustments that still need to be made given some of the volatility that we still see in crypto right now?
Yeah, absolutely. So our investment strategist team and research team have found in a 60-40 portfolio, 4% gives you the optimal diversification. I think right now a lot of portfolio managers are looking for effective diversifiers, particularly as we see what's happening in rate markets, as your last guest just talked about, as we see increasing correlation on the equity side. People are looking for effective diversifiers, and I think Bitcoin can be one, and that's becoming more popular, particularly as we see firms like Morgan Stanley. What they're allowing clients to do, by the way, is not access physical Bitcoin, but funds that are exposed to Bitcoin. We've seen a lot of inflows into funds. We have $5 billion in AUM on our platform. Total funds that are publicly listed have $56 billion in them. So this is really the route people are taking. They're not buying Bitcoin directly quite yet. I think we're still a few steps away from that.
Right.
But it has become a really effective diversifier. We do recommend redistributing. So because Bitcoin has trebled since the start of the year, we do advocate for rebalancing on a quarterly basis to keep those portfolio weights in check. But that is an effective strategy. And volatility really is part of the price of exposure. Bitcoin's volatility story right now is no different than gold's in the early 1990s, right, when it first became popular.
So in your experience, how many, people put a little bit of their portfolio into Bitcoin. How much is it because they really believe in Bitcoin and want that exposure versus I think it might be kind of nonsense, but I'm not sure. But just in case it's a big thing and going to get bigger, I want a little piece of it.
Yeah, so let's separate between retail investors
Sure.
and institutional investors. I think to date, the majority of inflows into the crypto space have been driven by retail investors. And really the first time that flipped in earnest was in Q4 of last year, where for the first time, institutional inflows outpaced retail inflows. And what we have seen, I think right now, there's a lot of talk about rates and the debasement of the dollar. I think really the story is much simpler. If you're an investor right now, you're looking for ways to allocate long-term and to minimize negative tax impacts. People are looking for things that they can hold in their portfolios for duration of at least 1 year. And I think Bitcoin as a secular investment is something that people are increasingly interested in having exposure to.
Yeah.
Now, there are different ways to dress up the narrative, right, and make it more palatable maybe for mainstream media or for a hot TV spot. But I really do think the story is around portfolio construction, diversification, and these tax impacts that we're all looking out for with the Biden administration and their plans to tax much more aggressively.
But as we see people, more people sort of embrace crypto as an asset here, there's still questions about why we haven't seen a little bit more loosening on the regulatory side with regards to allowing ETFs and other sort of vehicles that might make it easier to invest.
Absolutely. But I think, to be fair, right, we've seen a lot of inflows into funds and structured products. We're also seeing more and more financial firms offering direct access to crypto. We joked, at the start of this that Morgan Stanley was giving their wealthy clients access to crypto. But I think retail clients now have a variety of ways to get access, whether that's through Square's Cash App, Robinhood, now PayPal as well. So generally speaking, Bitcoin is becoming increasingly accessible across a variety of platforms.
Yeah.
While it may not be integrated into retail brokerage platforms like Schwab and Fidelity and Vanguard yet, I certainly think all of those firms are actively looking at ways to get retail exposure.
Well, the one thing, Milton, though, that a lot of people have brought up, though, is just really just the cost, though, of investing in there, or the fee, the fees that you're paying just to get in or get out, and that's why a lot of people are saying it would be nice to have an ETF or some other sort of low-cost vehicle where you can maybe track some of these currencies.
Absolutely. We are 100% on board with that. We have actually partnered with a retirement account provider here in the U.S. called Choice that offers no-fee crypto retirement products. We think that will become more popular. We have firms like BlockFi, which recently raised money at a $3 billion valuation that actually allows people to generate income on their crypto assets. So I think, again, as we see crypto and Bitcoin in particular becoming more integrated into our existing financial system, we're going to see fixed income products. We're going to see a variety of fund products, and I think much more affordable routes for people to start to get exposure to this asset class.
All right, great stuff. Really appreciate you joining us, Milton Demirs, CoinShares Chief Strategy Officer.
And just a reminder to everyone out there, subscribe to our weekly podcast. It's called What'd You Miss This Week? You're going to find all our best content each Friday to enjoy over the weekend. It's available wherever you listen to podcasts, Joe. I think you should probably double up with Odd Lots or something.
I don't know about what you're going to do over the weekend, but I feel like listening to...
Do you go home and just listen to your own podcast?
No, actually, I can't stand the sound of my own voice. What about you?
I like your voice.
No, what about your own voice?
Oh, my own voice? I never listen to anything. I do.
No,
I just take it for granted that everything was great.
Yeah, okay, that's smart. I'm the exact opposite. All right, goodbye. That does it for What'd You Miss?
All right. Good night, Caroline. Bloomberg Technology. Up next in the U.S. Caroline will be back on Monday.
But you
Have a great
right?
weekend.
This
is Bloomberg, maybe.